Hello, everyone. Well, it's a tremendous pleasure for me to welcome Guillaume among us. Not only has Guillaume been a friend for many years, we grew up in Switzerland, in Geneva together, went to the same school early on. Obviously, someone went way beyond that stage since then. And no, it's quite fascinating, and we feel very lucky to have Guillaume with us today. As many of you know, Guillaume has built Checkout.com, which today is the most valuable startup in Europe, also due to some things happening in the market, which we'll be, I'm sure, touching on. But today, I really wanted to discuss with Guillaume basically his background and what I think makes Checkout and your story as an entrepreneur so unique, the way you've built your company very patiently and bootstrapping it to, again, become now the largest and most valuable startup in Europe. So, you know, as I mentioned, you grew up in Geneva, you studied in the Swiss Technology Institute in Lausanne, also the HEC in Lausanne, and I guess my first question is, you know, coming from, well, the similar background, I mean, what drew you to the payments industry and what triggered your wish to create your own company?
So thank you very much for having me, and happy to be here with you today. I think any entrepreneur, it always starts with curiosity and, you know, interest or passion. I mean, it's very hard to say I'm going to start a company in a subject I'm not interested. If you remember from our childhood, I was very keen on computers at a very young age. So I have spent a lot of time with computers, and by spending this time, you also see the power of the internet. You see Moore's law, you know, obviously computing power going, you know, increasing for a decreasing price. You see the internet going faster every year, and you start thinking that the world around you is going to be changing, and the way people interact with devices is going to be changing. I think our first phones were like a Nokia 3320, like, you know, the brick, the plastic, and I had the curiosity for the internet. I spent a lot of time on my childhood on it in general, and then when you start a company, you know, the problem of payments was one that was interesting. It's a nearly infinite TAM. The latest numbers, even now in 2022, is that e-commerce is only 12% of total transactions globally. At the time, when we started this business, I think it was the iPhone 4, Facebook or Gmail was like barely launching. And so we thought to ourselves, there is interesting, complex, and problems to solve, and it's a topic I have interest in, essentially.
Yeah, but I think that's what's so fascinating, because you started, as you mentioned, quite early on, when the overall technology ecosystem wasn't what it is today. And it took you, or you waited 7 years until you raised your first external funding. That means you bootstrapped your company from that early stage all the way to 3 years ago, 2019, when you raised your first, the Series A of Checkout at record levels. I mean, that's pretty remarkable and unusual for a startup. And so I guess my first question on this is, would you recommend this approach to other founders?
Well, I think every founder is very different, and we all have our own journey. What's for sure is I believe that the historical Silicon Valley model of, like, you know, grow really fast and, you know, like blitz scaling does not apply to everyone. Maybe in consumer spaces it does make sense to go really fast. But it's funny, I had that discussion with Reid Hoffman directly, saying, like, I disagree with your model. You might have written a very successful book. In B2B, the best product wins quite often. You know who your customers. We have 1,700 customers. We process for Facebook, ByteDance, Klarna. We know the ones we don't have, you know, Amazon, Google, Microsoft. And so what matters, these are educated buyers. They're going to choose you on the product. In B2B also, you don't, I mean, in our space specifically, when we applied to the FSA, which is now the FCA in the UK, we had 4 employees. And they gave us a license because I guess we had a good application. We then received the license from Visa and MasterCard in 2013, so the FSA was in December 2012. At that point in time, we started receiving term sheets. We just decided that we didn't want to take the money. And one of the things I deeply believe in is that you don't need big teams to ultimately run successful companies. Of course, over time, it's going to come, but in the early days, this is a Mark Zuckerberg, a decent, famous quote, is that 5 good engineers are better than 100 average ones. What's his name? Pavel Durov from Telegram has 50 engineers for an application that is used by 700 million users globally. So we decided to have a very concentrated team of people who actually chose the complex problems as a challenge. I often say that the best engineers are not driven by money. The ones who are driven by the ones who choose you for money leave you for money. It's always been like this. But they're actually, when you say to somebody, we're going to go crack this problem, which now we have Stripe and Adyen as kind of main competitors. But at the time, Stripe was nowhere to be found, and Adyen was, emerging. But it was the same problem we were going after, is like offer global acceptance to, the world's largest companies and do it well in a disintermediated way. It's an exciting topic for many good engineers. Let me put it this way.
So it's a perfect segue to my next question is you mentioned some giant companies, or there are giant companies today, Adyen and Stripe. How did you compete on recruitment? How did you compete against better funded competitors during that time?
So, I mean, we're running very lean in a very frugal way. I think it's I believe in the Swiss approach of being very disciplined and methodical. Something that I often joke with my investors. I'm a very Swiss guy, so I'm square and organized. And you write a plan, you execute the plan. There is really two models. I mean, even if we go back to these competitors, Adyen is one of the most efficient companies globally in public markets, running at a 40% growth rate year on year and a 60% EBITDA margin. So it's a rule of 100, and they raised a total of like 200 million through their lifetime. We took a different approach. Stripe took a different approach. I think we indexed probably a bit in the middle, but we delayed as much as possible our fundraising because we wanted to have, if we go through the history now, so in 2012 we had the license from FSA, in 2013 we had the Visa MasterCard license, then we decided not to take the investor money, though it was actually on the table, because we said to ourselves, if we use a third-party platform to connect the Visa MasterCard, we're going to be basically just being like, dependent on somebody else to bring innovation to the market. So what was originally a one-year plan, which was it turned out to be a 3-year plan, a bit of a traversée du désert, was longer to build than we had anticipated. And in 2016, we relaunched in the UK and we signed back-to-back Revolut and TransferWise, which were obviously emerging and growing really fast. And as you're a fintech who's basically trying to challenge the banks in the UK, it seems incoherent to go and work with Barclaycard. So there was like a perfect kind of alignment of the stars for us. And in 2018, we won Netflix Fair Play, in front of Stripe and all the others. And this is where we decided, hey, this business is now 300 people. At that point, I was 10 million in EBITDA. It's time to go and take external capital and help us build a bigger business. Because I was not the CEO of a 300, I had never been the CEO of a 300 people company, and now we have, he said 1,700 before, it's 2,200, and we hire 100 people a month. We don't talk too much about the headcount because it's a vanity metric, and certainly in this ecosystem, it would sound like a wrong, argument to make to the press. But I have amazing investors, have been very good to me and have helped me become a better CEO. And I heard you mentioned also the values that have, I think, led Checkout since the beginning, and those are Aspire, Excel, and Unite. Have those also been paramount to attracting, retaining that talent maybe early on? And how do you continue to apply those values nowadays? So we still apply the value. They've been there since the beginning. And what's funny is that it's like, you will see companies like Amazon who has like 15 operating principles. I'm a big believer that if the formula is too complex, the employees don't remember. It's very important to simplify something to the minimum. And we have the values, and we have the operating principles, and we have the mission. The values are external, and the mission is external. The operating principles are internal. But one of our operating principles is what we call extreme clarity, as in like you have to be able to explain something to somebody, and there should be 0 questions after it. So like because when you have 2,200 employees across 21 offices, if you don't have extreme clarity, things get lost, and then you have friction, and then you lose in efficiency. And the values are very simple. It's something I've always believed in since the early days, is that you aspire to build big things, you execute perfectly, this is Excel, and you unite people behind your decision. All the best leaders or the best CEOs have managed to, regroup people behind them. And the more people you have behind you, the bigger you can dream and aspire. So there is a flywheel effect. And that's a formula that we believe in since the early days. If you ask me today if I knew I would have a 2,200 employee company, I'd certainly tell you I didn't think it was even possible at the time. Obviously, we had big dreams, and everything kind of s'enchaîne, comes after one after the other. But the reality is that today we still believe we're at chapter 0, and we're going to be able to do a lot more. We have a very strong balance sheet. We're a very profitable business. And like I said before, only 12% of transactions are online at this point. So it's just a matter of executing well, believe in your values, believe in the quality of the company that you're building, and staying focused.
Now, you're clearly leading your company with a lot of purpose here and a clear purpose. To bounce on what you just said, I mean, you said the checkout is at chapter 0 still, and you mentioned that you're facing an almost infinite market, which is just in its infancy. And we have seen that many of the fintech companies started as a single product, often as single product companies, to then expand into multi-products. I mean, where do you see, or what is your ultimate ambition for checkout?
I think all fintechs eventually end up being multi-products, the ones that are successful, but we're not doing anything different than the banks. The moment you have multiple revenue touch points with a customer, you can start subsidizing the margin from one revenue touch point to another. And essentially, you can then become, if you have a competitor that annoys you in one part of the business, you can really subsidize massively and essentially create a moat and a better retention with that customer. We started as moving money inside the businesses. Then we realized there was a lot of money in moving money outside of the businesses. We do hundreds of millions of payouts at this point. And now there is everything that has to do with treasury, what we call the CFO suite. We don't do lending today, but we do advanced settlements. So we would basically make, from a working capital, the money available to merchants faster than we receive it from Visa, MasterCard. And so there's just a lot of opportunities in how to run efficiently a business, because we're not a bank. We are an EMI in most countries, which is an electronic money issuer, which actually gives us access to payment methods indirect, at least under PSD here in Europe. But we are in control of our merchants' revenue. I see the dollars of Netflix before they go into Netflix bank account. And I think, just to give an idea to the scale, we have 600 million cards in our database, in our vault. So I think I can guarantee that in this room here, 90% of people we would have touched in a way or another. Because we have most of the biggest, if it's a food delivery company, Smooth here, or they're customers of ours.
And actually your mission is focused on helping merchants thrive, right? That's how you define your mission nowadays.
Yeah, we say it's enable merchants and their businesses and their communities to thrive in the digital economy. Yeah. And I think, funny enough, I always flip on the merchants, because I have this, we come from a merchant background. Now it's a lot more about businesses in general. And the words that are really important is the word enabling. Is there is companies that want to be very visible. Revolut or Klarna, they want to have the consumer relationship. We're much happy to be a bit in the background or behind and being an enabler of others, because it is a perfect alignment in the kind of equation of value, which is if they are successful, we are successful. And so this is something that works really well for us. I'm not saying that we will never be a consumer-facing brand, because like I said, there's plenty of other revenue, other products in fintech that you can build. But right now, it makes a lot of sense for us to just be behind the scenes and process transactions at scale against the right level of unit economics.
And you used the term equation of value, which is a term I heard you also using when you explained how you built your fundraising strategy, basically. And I think it's quite interesting for the audience to realize how much thought you've put into this. Can you explain a little bit how you think about these different equation, or the evolution of the equation of value across the different rounds, and maybe what are you looking to optimize at this stage?
I think so this is another it's not an operating principle, but it's a term we use a lot internally, is that in any transactions that you do, in any relationship with an employee or a colleague, when you do a transaction of any sort, there's going to be a transfer of like service against something, and it's very important that the value transferred is equal on both sides. That there is not a side that is, à défaut, like who's getting less than the other. And so the way, when we looked at our fundraising, we obviously had a strategy on like how we approached the fundraising, because obviously I'm transferring shares in exchange for dollars that we didn't need and we actually never spent. So like it's pure balance sheet money. And obviously we wanted help in terms of building a big business. And so the way we approached this is that the first thing I wanted an operator, and I ended up taking Insight Partners, who's a very large fund in New York. They did 65 IPOs. They've scaled software companies, and software and fintech is very close. We have a consumption model. It's a similar model, at least on the payment side. So we wanted them. We took DST Global because they had amazing relationships in the Silicon Valley, and they have helped me win some of the merchants that we were, aspiring to win. We took Ribbit Capital, which is a fintech-focused fund, but who knew if you believe in a multi-product strategy, you want somebody who truly understands fintech. And then we took GIC because we wanted help in Asia as we were expanding there, and that was the equation of value at that point in time. On the Series B and Series C, we wanted people who were more on the crossover side, and then we decided to go and build like a coalition of some of the best hedge fund managers, which obviously today are probably suffering a little bit when you read DFT, but that was like Tiger, Dragoneer, Altimeter, Green Oaks, which are all Go2 also. Obviously, Philippe would be unhappy if I don't mention him, but he is, and Philippe, by the way, is a good example. It's a person who actually has given me a lot of personal time and helping me think on how to build a big business, because he's been very close to founders who have built very large companies that compound revenues across decades, which is what we are actually, supposed to do. And then just the last round was now, I changed my whole management team. They all have, IPO or public market experience. Céline, the CFO, comes from T. Rowe Price. She was the CFO and COO of T. Rowe. And we have Meron, who's like the CPO, so the head of product, comes out of Facebook. My CTO was the CTO of Twilio, the US listed company. And what they all said is that when you actually go closer to an IPO or an offering, you want very much stability into your share price, and you want shareholders who are going to stay with you for a very long period of time. And that's where in our Series D, the focus changed entirely from crossover/hedge funds that have a more trading mentality. And we went on and we took a 200 million from Capital Group, then GIC, again, QIA, Franklin Templeton, people who are very long-term, who are, these investors, the moment you become a public company, information becomes completely standard. So they're actually very happy to build a relationship with founding teams in private markets. They can better underwrite your decision-making. We're happy to be able to build that relationship with them now and essentially have shareholders, which will be long-time shareholders in public markets.
And even though we are small shareholders at ACE, we intend to be a long-term shareholders of Checkout. And maybe also something that's quite important. I mean, you touched on, of course, the state of the market. I think we discussed this enough over the last 48 hours here. But I think it's quite important for the audience to realize that, your timing was quite impeccable on the latest Series D. You basically sitting on a lot of cash reserves at the moment. Your business has been operated profitably since inception, almost, I want to say.
Last years.
And so when you look at some of the competitors who are suffering more at the moment, I guess my question is, what is the strategy for you now? Do you want to actually double down and be even more aggressive than you had planned to be, or do you take also maybe a more conservative and cautious approach?
No, we're actually executing the plan. I mean, I'm a big believer. I said I'm very Swiss. We had a plan that we believe delivers the best returns, the best ROI on our time, and the right sequencing to build a business. What's for sure is that I'd say to my HR team, be very aggressive in the FANG or the MANGs, because all these people, all the employees are in the red at this point in time, and they have very good employees. It's very simple. When you get RSUs and your stock is tanking, these people become very much easier to poach. Yeah. And same thing with Series B and Series C companies. where you sometimes have very good talent. All the good tech companies index on Radford, which is the benchmark for knowing where salaries are in tech companies. And my employees, unfortunately for me, that's the state of the market, at least until last year, where all the engineers and product people are increased by 5 to 7% every 6 months just to stay into band. And band is like, do you want to pay 50% of Radford, 75% of Radford, or 90%, which is where like the FANGs or the Mangs are. And so what we do know is that there's a lot of Series B, Series C companies today that now are outside of band because they're not increasing salaries because they're going through rationalization. And then, yes, we need to be very aggressive. But it's just, we're not going to hire more people than we had planned. We're going to add about 1,000 people this year. But the reality is that we have better opportunities in the people that we can poach, because some people who would not have changed job last year, this time are going to be like, more thinking in terms of like, do I want to take a risk with my career? Or like all these RSUs are being wiped out. It's time to think about what my future is.
Definitely. And you mentioned obviously that you reshuffled your C-suite team. And so IPO is still very much a focus for the years to come?
Yeah, I think it's like it's the natural path to a company like ours. We mentioned I did before, they did it very successfully with all the success that we know. I think like we operate as a public company internally. So we have our quarterly earnings call with our investors. We have, a good public company is a company who has predictability. So, and it's not only revenue and cost. It's going to be like, hey, I have this product launches for the next 3 years. Am I actually hitting my product launches? Do I have all the right marketing collaterals, the sales enablement tools? Do I have the right productivity metrics into my sales team? And I think like the more you can build that predictability, the more your time into public markets will be easier, because you will be exactly on point on what you actually have said to the analysts and the people that actually cover you in research. Do we have? It's obvious that our main peer has went down by 40% in the last 6 months. This is something that is for people like you. Investors care about entry point, exit point, and obviously the multiple, because it has a huge impact on your IRR. I care about compounding net revenues and the margin at which I'm doing that. So our perspective is that we obviously need to create a good return for shareholders. We raised money 3 years ago for the first time. Nobody is asking us to return capital today, but I have a moral duty to my people to actually at some point giving them a liquidity event. I mean, the WeFox story before was actually very impressive, and I think all the big founders care for their team. Mm-hmm. So you build a very competitive, high standards, high performance environment, but the people who work really hard for you, you have to reward them properly.
Well, definitely. I want to take the last 2 minutes also because you also wear another hat, which is an investor's hat. I know you're supporting a lot of startups and innovative companies from early on. Can you tell us a little bit how you approach this, and maybe what are the areas of focus for your own private investments?
So I'm not the one, as you know, I'm not the one who's doing it personally. One of my mentors is Jorge Paulo Lehmann from 3G Capital. And I really like Jorge because he is 80 years old, and he has seen bad credit cycles, so he knows what we're going into. And it's actually very important to have mentors and people who push you to start thinking differently. And if you only speak to tech guys, all they've seen is the biggest, bull market in the last 14 years. So they would probably they'd be indexing on the wrong things. And I often joke with him, and I was like, how did you say so smart? And he's like, by staying close to young entrepreneurs. It's the brain is a muscle, which, by the way, I deeply believe in. And so the investment practice is we understand technology. We have a lot of asymmetrical information, just in the sense of from a, understanding of where the market is. I've been doing internet things now from the age of 12 years old to now. It's a sector I still have a lot of interest as a whole. And then what I say to Guillaume, and I know it's confusing, it's the other partner in the firm that actually he is running out of London, is that the smartest entrepreneurs that you see, I want to speak to 6 every month. So I have 3 hours of call that we actually are able to get into their round or not be able to get into their rounds. I care, how do I stay relevant as a CEO is by staying smart. Mm-hmm. And I think, people care about what we call the rate of innovation. People choose payment companies for 3 things, essentially. They choose us for price to quality or price to performance. Obviously, this is a very important metric. Your rate of innovation and your service. And the rate of innovation will depend about how well you underwrite the secular trends and the changes the world is actually going through. And the last thing I want to be is, the guy in an ivory tower who's starting to think that he knows better than others. So go and speak to smart founders who actually are out of X in Paris or a PFL here, who are trying to build something and will give you their view of the world, which is quite often very relevant. And we always play these 30 minutes the same way. You ask me questions for 15 minutes and I ask you questions for 15 minutes. And I have no investment power in the VC firm that the other Guillaume runs. He's on the IC, it's not me.
I see it. Well, our time's up. It's unfortunate because I could ask many more questions on that front, and I know you invest a lot in cryptos. But well, first of all, thank you very much for giving us your time today. And I think it's great to leave on this note that indeed any founders, even if they are younger, but as long as they're motivated and they come with an innovative spirit, can teach all of us very valuable lessons. So
it is the first value of checkout. Never stop dreaming. Aspire.